When a modern Indian mega IPO launches, millions of retail investors send their funds to converge on a single corporate entity. Absorbing this massive influx of cash requires navigating a highly regulated accounting gauntlet. Every rupee mobilized must align with the strict boundaries set by the Companies Act 2013 and the rigorous disclosure norms of the Securities and Exchange Board of India. The corporate accountant's core challenge is filtering abstract, theoretical wealth through market realities to establish a true financial bedrock. We are going to trace the exact mathematical and legal life cycle of corporate securities, starting from the company's constitutional documents and ending with the Schedule 3 balance sheet. Understanding this process reveals how legal corporate strategy is engineered into a mathematically flawless financial reality. This model begins with authorized capital, the absolute constitutional ceiling codified within a company's memorandum of association. The board slices out a specific fraction to create issued capital. This block then filters down into subscribed capital, reflecting the portion the market actually agrees to purchase. If that subscribed portion does not meet SEBI's mandate of at least 90% of the public issue, the law mandates an immediate refund of all application money. Assuming the issue succeeds, the subscribed block splits again. Called up capital represents the exact funds explicitly demanded by the board, leaving the remainder as uncalled capital, a legal buffer for future use. This structural subdivision gives regulators and investors transparent visibility into a company's maximum funding capacity versus its actual cash demand. Companies rarely demand the full share price up front. They stagger the collection to match their project funding needs and to ease the financial burden on the investor. This journal entry matrix tracks the application stage. Investor funds land in escrow, generating a temporary corporate liability recorded as share application. Upon formal approval, the allotment stage begins. The temporary liability is extinguished and transferred into true share capital, creating the shareholder relationship. Subsequent collection stages, known as calls, establish a formal debtor relationship that legally obligates the shareholders to pay their remaining balance on demand. If those shares are priced higher than their face value, Section 52 dictates that the excess cash must sit in a heavily restricted securities premium account, isolated from standard capital. Conversely, Section 53 strictly prohibits public companies from issuing equity shares at a discount to the public. This installment accounting mechanism protects corporate cash flow while locking investors into a binding ownership contract. In bullish markets, investor enthusiasm often breaks the model. Public applications can massively exceed the available issued capital. Rather than rejecting thousands of applications, the board executes a pro rata allotment, proportionally scaling down the number of shares awarded to each applicant. As shown here, the excess cash is redirected forward into the share allotment bucket. Retaining this excess cash to offset the investor's upcoming dues is mathematically more efficient than processing millions of micro-refunds. But the ledger also has to handle the opposite problem: investors failing to pay their demanded allotment or call money by the strict deadlines. These deficits are recorded as calls in arrears. They sit on the ledger as negative weights, mathematically reducing the final called-up capital to reflect actual cash realized. To penalize these defaults, Table F of the Companies Act authorizes the board to charge a statutory interest rate of up to 10% on those missing funds. The corporate ledger acts as a dynamic equalizer, rigorously balancing mass investor enthusiasm against individual failure. When an investor persistently defaults on those call notices, the company initiates forfeiture, the final draconian consequence that nullifies their legal contract. Forfeiture forces an immediate structural contraction of the company's equity base. Look at this share capital T account. To execute the cancellation, the exact value previously called up on those specific shares must be debited, reversing it out of the ledger. This creates a severe audit trap if the forfeited shares were originally issued at a premium. The rule diverges based on cash flow. If the premium was already realized, the statute protects it. It is untouchable. But if the premium was due and remains unpaid, the securities premium account must be explicitly reversed alongside the share capital. The cash that the defaulting investor did manage to pay is completely confiscated, parked in a specialized share forfeiture account. The company can then reissue these confiscated shares to new investors. Because the company already retained partial payment from the original defaulter, it can legally reissue them at a discount, bypassing the Section 53 ban. Once reissued, any leftover, unutilized cash sitting in the forfeiture account is permanently transferred to the capital reserve. The forfeiture process resets the capital structure, effectively converting a shareholder's default into a permanent capital gain for the surviving corporation. Contrast this risk-absorbing equity structure with strict corporate leverage, the issue of debentures. Because debentures represent legally binding creditor debt rather than ownership stakes, they are exempt from the Section 53 discount prohibition. Debt accounting heavily prioritizes the prudence concept, particularly regarding the future terms of redemption. In this split ledger entry, if the contract promises to redeem a debenture at a premium years from now, that future payout must be mathematically booked as an immediate loss on the exact day of issue. Equity accounting manages shifting ownership risk and capital retention. Debt accounting enforces absolute creditor leverage and preemptive loss recognition. After filtering the capital through months of applications, pro rata scaling, and complex forfeitures, every variable must arrive at its final destination. This Note to Accounts table, mandated by Part 1 of Schedule 3, documents the exact mathematical descent from authorized maximums down to the subscribed reality. From the subscribed called-up capital, we execute the final strict deduction, subtracting the dead weight of the remaining calls and arrears. Then we execute the final addition, adding back the unreissued cash balance currently sitting in the share forfeiture account. That final calculated residue is the paid-up share capital, the single solitary figure transferred to the face of the final balance sheet. Corporate accounting translates millions of erratic market decisions and complex regulatory strategies into an unimpeachable, mathematically proven financial truth.